experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Well, folks, I apologize for yesterday. It ended up to be a local internet issue that disrupted the podcast yesterday. So today we'll go ahead and we'll talk about the tech rally that happened today. I think we're getting really close to this blow-off being done. So let's get into today's video. Hey everyone, welcome. I apologized already, but I'll do it again. Yesterday was a glitch in the internet local here, so that happens. I don't have my business hookup that I usually have at my studio, so I have a typical residential, so you have to deal with what you deal with at this moment in time. Anyway, a couple things. Another big rally. NASDAQ up almost 1% again. Pushing into new highs, and it just keeps kind of going. I'm working on I have a number of projects, but one of the things that I have done, the fact sheets that I've been showing you for a number of months now, are actually pretty cool, and they're very, very useful and very helpful for certain types of trading. In the last couple of days, I've actually been venturing into some really serious math that encompasses decades of my work. And what I saw out of this thing it's early development, but it's basically the ability to do some really deep trend analysis, also looking for reversals and events. I've talked to you folks over the years many times that I'm a bar counter. So I'm looking at all these different bar patterns, and I'm now teaching the AI to think about the bar patterns and how to recognize them. And the good news is I have some logic that will choose the highs and lows and all of that stuff. So there's some intriguing work I'm doing. So at some stage, I will reveal this is kind of the next level thought. And I talked to you yesterday about the dependency on everything. And of course, right after I said that, maybe I'll jinx the stream again today. But right after I said that yesterday, everything went down, right? So we're continuing. Been seeing some things. I'm primarily a Claude and Claude Code user. For the most part, I don't use GPT that much for any kind of work-related stuff. It tends to do better for retail, at least from my viewpoint. When it comes to programming, it's hard to beat Claude Code and some other things. But those dependencies are the entire network of all of us, everybody on the planet, big and small companies, individuals are becoming more reliant upon these LLMs as they get more sophisticated, get even better as they go on. They have a lot of little nuances that you have to be aware of. But anyway, we're all getting more and more dependent on these things to the point what I think I heard somewhere that Microsoft's buying a nuclear plant or something. So there you go. I mean, we're going to need lots of energy. And it's interesting because one of the big winners on the intermediate models has been utilities, which I've talked about before, are probably as important as the tech sector themselves. And that's, it's an interesting situation that's happening, especially with the micronuclear and other areas. And I'll probably end up doing a special report. I started working on some things about working on the Russell, trying to figure out if that thing's ever actually going to make this giant move that people like Tom Lee and others are trying to claim that it will. I don't see it right now. I think it's sort of interesting. There's some other noise going on around, which we'll come into even more so, the Federal Reserve. And, there is a big movement to what I'm seeing anyway, noise out of the Trump administration to clean house at the Fed. These guys they're sort of like all of these economists and all these people. They're just the worst. I've been around Wall Street a very, very long time, and I'm always trashing these guys, but they're just not good at what they do, and probably, and sorry, I don't mean to offend anybody, but probably some of the worst people out there from a community standpoint. There's good people on everywhere, right? There are some good economists, but the bulk of these folks that come out there and run their mouth, I have no clue what's going to go on, and they come across like they know what they're talking about. I spent almost 3 decades working with investment advisors, and there's some good ones, but most, I'm going to go 85%, aren't worth their salt. And the reason is that they're all pigeonholed into certain types of thought process that they've been told you can't time the market. They've been told so many things you can't do. They do nothing. It's the only place I know that you pay a fee to have somebody do nothing, to buy and hold your assets and handhold. So, and especially on the upper level. So, my goal is to continue to try to do some technical and quantitative things that I've learned that works really well to help you folks make money. So I always, start off that, I'm here to, help you manage your money and protect your wealth. That's really where my head's at here on this thing. And my goals are to start to bring out some products that are going to actually do that. And like I've said before, I'm going to show you the WaveTech database. That's old school. What I've been building into that is intelligence, how to do analysis of it, forward-looking, probabilities, a whole lot of stuff. You have to realize that we now have, with these LLMs and some of these other coding tools and things out here, we now have access to the smartest and the best of everything. And GPT-5 comes out, maybe I'll definitely be digging into it. But there's so much stuff out there now. It's getting so good that it's impossible to be better than any of it. But it's also possible, if you know just enough, you can actually do some amazing things. I can tell you, I haven't shown you folks all the projects that I'm working on in secret, but I've got some. I was talking to an old client of over 2 decades with me, and I was telling him a few things and sharing some things that what I'm about to do is going to be groundbreaking, and I'm really excited about it. And the only reason why I'm telling you about this is it's important to understand the context when you're trying to, there's a difference between speculating, and we're going to talk about indexes and price movements and those kind of things. It's a much different thing when you start talking about actually managing money and managing pools of assets, which is a much different concept than just trying to figure out whether the S&P is going to go up or down. So there's a lot of things that I plan on bringing in. It's sort of from my viewpoint, if I get to hang around this planet for another 5-10 years or more, I have some things that have come out of my past. It's one thing to come up with new ideas. It's another thing to have all of the knowledge that I have and experience of watching market movements and things I've learned that you can only learn by doing, and bringing that into next level intelligence and getting to build off of that. So I'm very excited about life. It's interesting. I'll be 73 years old here in the next few weeks, and to be very excited about what's going on and what the future lies. It's very interesting. So I'm hoping to leave some artifacts on the planet that will help everybody longer term. So let's get into talking about the markets. The interesting situation we're saying, we're continuing to see markets bump up. We got to over 6,300 on the S&P again. It's starting to pull back a little bit. I've run the sheets. We keep going from going bullish to the potential of getting a little frothy at the top here. I've talked about this over the past several weeks that my expectation is that we would be able to get some kind of rotation or reaction out of here. And there's no news, right? So there's nothing to go off of. So all the traders, all the money flow is going to what they know. So it's Nvidia, it's the tech stocks. That's all the markets know for the most part, and those are top weighted stocks on both the S&P, as I've said, and the Nasdaq. They're cousins. They have similar constituents in both of those indexes. So they kind of keep on trucking, keep going higher and higher and higher. And at some stage, if there is some actual knowledge on what the economy is expanding, like I said, the markets are not the economy, and the economy is not the market. So sometimes there's perfectly in sync. Most of the time, there's some divergence going on between those, negative or positive. And what I'm seeing in our database, which really kind of cuts through all the noise, is we're seeing the ability for the database, which I'll show you here in a minute, just to continue to stay very elevated in the percent bullish, or the number of stocks that are participating in this. And I know a lot of folks, they'll talk about the Mag 7 and all that. And yes, from an index standpoint, they're heavily weighted. But there are, tens of thousands of equities and other instruments out there. And there's another story that's been told. And I have talked to you folks that ran into me 5 years ago when I opened up kind of to the public. And, there's a lot of stocks participating. Like right now, 11,224 of them. And so when we see broad participation, and what these are not stocks that are above their 200-day or 50-day or some, really low-level analysis like that, or not above a trend line or something really silly like that. It's really, these are that are recognized to have characteristics of trending characteristics. And there's what's being looked at here is there's 60 primary rules, and there's over 600 variables that are looked at every night. What just ran just in the last hour and a half is about 10 million calculations. And I can tell you what I'm learning right now from all of that massive database and history and experience, not only of using it, but actually being the architect and building all these technologies over the last, really started in 1983, 84 is when this process started. There's a lot of other things that are coming out of that knowledge and that experience that is really, my head's spinning when I think about it sometimes. I'm super excited about some of the things that I'm realizing that I can now go and dig into. So the point is that there are a lot of symbols participating in this rally on a short-term level. On an intermediate term, it's starting to grow as well, and I suspect it's going to continue to grow. And now, just to back up a few things that I've said over the time, is that I'm still kind of expecting the economy is going to hit a wall here. Maybe we'll see. There's a lot of metrics. I saw Scott Bessent talking, I think, at the cabinet meeting, that the U.S. has brought in $100 billion in tariffs so far this year, and they're expecting it to get to 300 by year end. And so that's a big number. Okay, that's like if Doge cut $100 billion, all of a sudden you got $500 billion that didn't exist before. So it's going to be interesting going forward to see whether Trump administration can pull off all this stuff that they're trying to do, and what happens to that. So if you're a Substack newsletter reader of mine, go look at the GDP models. I put it in last night, so you can click on that, play with those models, but also look at the beautiful Big Bill model, where that's really more of just a dashboard of the metrics. But the things that are possible with the amount of investment that's going to be into utilities that I discussed a few minutes ago, as well as other technologies that are going to expand very quickly, including robotics. I know I saw somebody on YouTube comment said, I'm not going to spend $40,000 to have a robot do my laundry. There's so many applications to a home robot, especially me as an elderly man looking at, maybe I could stay in my house and have one or two robots to take care of me, and I don't have to end up in one of these nasty hospitals that no one cares about you, and like some assisted living care. And I've had family members and other folks that I know that have went through that. It's nasty, terrible, and you don't want to ever go there, right? So how cool would it be to have, a couple of these robots that can do everything, maybe even administer medical, who knows where this thing goes. So I think from there's much more utility than some folks are putting out there. But my point of putting all this out there is there's going to be, going forward, I still am very, very bullish longer term. I think mid-26 is where we start to see some real acceleration in GDP. As far as we're sitting here right now, I think we're in a transition from the standpoint. There's so much uncertainty. Uncertainty meaning we were told that tariffs were going to cause massive inflation and all this stuff. It was all anything anti-Trump. It's not actually being anti-Trump. It's just being anti-math if you look at it. And this is why I put that GDP together too, so you could see that worksheet and you can interact with it and actually change the metrics. You could try to make it as bad as you can or as good as you can, and you can see the variances that are possible. So I put that tool out there. I hope you folks have used it, because I think it's really cool and when you're trying to visualize and looking out. So all of us have to do something. I always talk to you about reverse fundamentals. I'm looking out at the future. I did a long-term breakdown of the S&P at the beginning of this month. And when you start to look out 2, 3, 4, maybe 8 quarters, looking out 2 and 3 years, you have to try to come up with some kind of scenario. So the nice thing is that GDP calculator really will help you do that. So this is probably going to be more of the things that I'm going to be able to do from the standpoint of giving tools to help. Okay, you don't have to just say, oh, this guy's wrong or he's right or all that. You can actually go out and test some of these theories. I've found a way to build these React dashboards that are going to help us all to understand and to validate or invalidate some of these thoughts. And it goes both ways, right? So I don't build them to prove to you that I'm right in this forecast. The idea is to have these models, and the Fed operates on them, even though they're seem to be all broken, but nonetheless they do. So a little bit in this loop a little bit here, but the point is we are, I think, coming to a point where there's not a lot of oxygen in the market. Doesn't mean it's going to roll over, collapse, or all that, but I think we keep grinding out. We keep, it's like, who's the last bag man? Who's going to buy the high? We used to talk about this on the trading floor days, right? So who's going to be the bag man on this trade? Otherwise, I used to say, you don't want your name in the Wall Street Journal, which is the high or the low of that session, right? So you sold the low or you bought the high, and we used to call them gotcha trades. And, you don't want to be in that position, but it happens. And you just have to be able to recognize that sometimes you did a gotcha trade, and you got to know how to reverse trades. And if you're trying to make money, that's a different scenario. But the point of what I'm talking about here is that the world going forward is going to be much different. I think what I'm watching closely for is dynamics that are going to change in cash flow in the markets. And to go all the way back to what I started in this little rant, is that really it comes down to, what do traders know right now? They know Mag 7, they know other related stocks, things that they know, crypto, whatever. So a lot of the money, I'm the baby boomer old dude, right? I've always been able to stay more on the bleeding edge and new technologies in my entire life. Most of that's still the case. But what happens here is everybody kind of gets into their groove. And what we're seeing right now is that's why the techs just keep leading, because no one knows anything else than that. And if you go on the, 2 million videos that are being made like this one today on YouTube, that it's all going to be the hype. You got a lot of millennial traders. There's some good ones. Most of them are big rank amateurs, but there are some good people out there, and they're the ones probably not talking to you. So anyway, let's get into today. So the plan will be, since we had failed efforts, I couldn't make it the day before, and then yesterday's collapse because of the internet connection. Let's try to get through. I go through the database. It's run. It's kind of starting to grind a little bit. I'll go through that. We'll hit on the S&P. I'll bring up the fact sheet, and then we'll get through the indices, kind of high level, try to catch up. And then tomorrow night I'll summarize the week, and we'll start to maybe start talking about next Fed meeting, what's likely to happen, and see if there's any overnight noise that comes out. So let's go ahead and get into the database. So we are at 76.78. Let me do one thing here. I just want to make sure 76.78 is the number up here. This is the symbols long. We got 91%, or otherwise we got 11 of the 12 sectors. Groups right now are 75. We're about the same as the symbols. But as we look down here, we're starting to get that rotation I talk about. So we had 100. If we just look at the 1.2 model, we've got 119 versus 138. And then on the usually combine these, so we're roughly looking at like 270 new buys, and we got basically 270 exits. So we're getting a rotation. We've got buys coming in, and the database is just staying static around this 76. And this is what I was referencing when I was discussing some of these elements out there, is really what we're seeing is this rotation starts. We get a rotation. There's some metrics that I watch for. And right now, this is very frothy. This is where if a market's going to stall, it looks like this, okay? And the stall meaning that on a short-term level that maybe we get 150, 200 point handle pullback, maybe on the S&P. That's a possibility. We're seeing a typical pattern. The one thing I can tell you, it's been, I don't know if you folks comment, but it's been an absolute killer market to trade. Day trading has just been insane. Buy low, sell high has been pretty simple to establish ranges. Just using 5-minute, 1-minute charts is what I usually use in trading. And I had a great day today, great day yesterday, and I think the last time I had a losing day was 6 weeks ago. So you just they're just setting it up really easy for everything, in my opinion. So we'll go through some of that range bound stuff, and we'll look at the symbols. But the database itself, just staying up there. We're going to start to see some rotation. It's not going to be big. I don't see a big negative market coming. I don't see any big downside. So when I talk about finally getting frothy and getting to the top, that doesn't necessarily mean it's the top and now we're going down. I think just the backdrop of everything that's going on, there's nothing that we can point to at the moment to make those kind of decisions from what I would call a catastrophic, like this is it, this is the top. I've been fortunate to make some really, really good calls over the years, but I don't see the criteria that would indicate that, if you see somebody screaming, I always tell everybody, if you see people drawing wedge trend lines on charts, do not pay attention to that. This is amateur hour. But what you want to watch for and this is the beauty of, from my viewpoint, and this drives me, and I've shared this with you folks, is that having the ability. I mean, how many analysts are looking at 14,618 stocks and ETFs and mutual funds, looking at all those symbols, and are consistently looking at them the same way, meaning I built these models. They do exactly what I tell them to do. There's only 2 of them. There's not 8 of them. I saw a website that somebody put together all these different little tools that you can use, like fill the gap tool, all these different things you see, what I always call the BS on stuff like Edwards and McGee and triangles and head and shoulder bottom tops. All that stuff is, if it was that easy, that's where all the money gets eaten in thoughts like that over the years. I've watched this stuff for over 40 years, right? So, but the point is, this gives us a bit of an edge. So if you've been able to hang around this channel, you know that to be true. And one of the things, I'll just pop this up for just a minute here, is if we go over and take a look at the intermediate for a second, this will give us, right here, we're 54%. So we're in a bullish enough position. We have we'll call it 8,000, we'll just round up. We have 8,000 symbols in trend mode on weekly intermediate charts. And I usually don't talk about this, but I'm going to tie it all together tonight. I feel like I'm catching up from the last couple of days. But one of the things that we want to look at here is over. Let me slide this over just a bit here. Let me get out of the way. These stats over here, if you have the WaveTech software, these are really good because it shows us kind of where we lie within the cycle of things. So right now, the average days long on all of the models optimized for the best model is right now is 39 trading days, better part of 2 months. Current is 25. We're duration fulfilled, we're about 66%. This will rotate a little bit, especially since we're starting to see a rotation go down. If we start to get some exits, this number will vary a lot, but will give us some insight to how low the percentage bullish is going to go. But here on the weekly optimize, right here, 208 trading days. I highlighted this. 208 trading days is the average holding period for the longer term models. And we come over here, the longest one is average 229. There's about 222 days, a little bit more in a full year. So the holding period is about a year. So when we start to get these holding periods start to extend a little bit like this, we're only right now, 24% through the cycle on the intermediate. And we're likely to get more longs as we come into this Friday. We're likely to get more buying coming in, and maybe we push up to 58, 62% is the next metric that I'm watching here. So we're getting a bit of elongated trends starting to happen here. And I made a comment earlier that a market is not the economy and the economy is not the market. So this is interesting because if we look at a cycle, we're looking at 1 year and we're only 25% through that. We can look forward with this metric going back all the way out to, Q1 of 26, maybe a little bit into Q2, depending on how this plays out. So the holding period is going to take us from where we sit right now in July all the way out to potentially May or July of next year if we continue to hold this traction and it doesn't drop back below 42%. So as long as we stay above that, we're looking at generally positive market going out for another year. So we look in the rearview mirror, what do we see? 23, 24, basis the S&P. I know this number well, so I'll quote it. 52.5 compounded rate of return. At one stage this year, we were down 21%. Now we're back up, close to 10%. So, we keep getting this positive rotation happen. Now the database is kicking in, and I know I'm going a little long here on this, but if we look back at 24, when we came in 2024, everybody told me the market's going to roll over, it's going to go down. I said, no, we're going to have back-to-back double-digit returns, and the database is at least going to go coming close into the election, which was going to bring us into July, August as a top. Well, what happened is we got a rotation, and it extended beyond that, and then we all know what happened through the election, and now we're getting another rotation. So when you're looking at 14,000 symbols and the cash flow of a larger market, you can start to draw some conclusions. And there's some, I always get people tell me, oh, your database lags. It actually doesn't. If you looked at some of these trades and these 14,000 symbols that we're monitoring, there's some amazing trades going on, and they're not all the Mag 7. There's some really, really big trades. I don't usually go down into the depths of the next level. But anyway, I kind of wanted to go through some of the database because this is the point where we are on the with the short term at 76% bullish. That is an important metric to understand. And then we got the other metrics with the intermediate still getting traction. And if we see more traction, it'll run on Friday. I'll talk about it on Sunday's video. If we get more traction like that, then that's just going to give us our forward-looking outlook even more to be more robust as we go forward. So, there has been periods of time, 5 and 6 years of bull markets to go. So if we look at we could actually, if you start to do some long-term analysis, we could actually compile a story going back, to the 2020 little dip there. And if you remember, when we came into the beginning, into 2019, came into 2020, we were at all-time highs when the whole pandemic thing happened. That's where we got a hit, and it just resumed. And you could draw a line just like through the market action, and you'll see a little V, and the market corrected and pretty much picked up that trend that got broken for a few months. And so when you start to look at longer term, you start to look at a bigger picture than just looking at what the price of a heavily top-weighted index is, like an S&P, like a NASDAQ. Then you kind of get skewed. So I decided tonight I was going to go into a bit of an in-depth and why this database is so important. All right, so let's go ahead and let's move over. I've got the NASDAQ. Let me go to S&P here. So this is something I talked about. It was kind of interesting if we go back and do a quick look back on this trend that we have here. If I move this around, well, these Fibonacci targets started calculating on August or April 2nd, and the downward targets were 51, 80, 49. Let me just zoom in on them so you can see, everybody can see these. Yeah, there were 50, 59, 49, 28, and 47, 83. We ended up going right in between fib target 2 and 3, and we hit a value of 48.32 was the low of the S&P on that current contract. It came right into fib targets, and then we end up getting basically a V bottom here. It's 2020 style bottom. And one of the things that I haven't talked about for a long time, it was interesting. If we were back in 1987, 88, 89, I called it the crash pattern, and it was on 5-minute charts, an hourly chart. All the charts reacted almost like the crash, where they would roll over and they got basically a V bottom. This is almost the 1987 matrix of how it recovered. And after the 87 crash, the markets, I believe by March or May of the following year, were at all-time new high. And so, these things recover really quickly, in spite of what Harry Dent or Peter Schiff or any of those guys want to tell you that, or maybe I'm going to put Dalio in there, the 100-year debt cycle and the end of the world, okay? The answer is markets don't usually do that, just because the longevity and, people want to stay alive. Governments will do whatever they have to do to survive, like we saw in any of them, the GFC in 2008, they just pumped all the money in. No bankers went to jail, and they pumped up the banks, and now the banks are quadruple the size of what they were in 2008. So all of these trends and things that happen here will continue to go on. Now, let's look at what's going on, and this is why I'm a little concerned about the current environment, and I've been talking about this. PPM1 is actually, you can see the red dots up here. Let me zoom in. Red dots are forecasting what the direction of the next several days, and we'll call it next eight-day sessions or so. So what we're looking at is the moving average is trying to roll over. There's still, if I come back here, the PPM1 is at right now still in trend mode, still in trend maintenance mode, right at 0.25. So that uptrend that's going on with that an angle of attack is what is driving this market and keeping it in this upward slope. It does look like as we come into maybe mid-July, we're going to see a rollover. Is that something to do with the Fed? I don't know. I don't know what the stimulus will be at the moment. But these patterns are starting to show up on all of the equities from the standpoint of equity indexes, the big ones, S&P and NASDAQ, which, once again, they're cousins. They have a lot of the same stocks, so some of these things are going to affect everybody. So anyway, but these patterns are starting to come in. Let me bring in let me see if I can publish this artifact here real quick and bring it over on the screen for you. All right, so let's just come here, and I will So this is the data sheet for today. 65% probability that we'll stay in a range. I haven't even looked at this. Expected volatility very low. This is what I've been also talking about, the contraction of the patterns that are happening right now. We're looking at some of the insights. So hey, for $8 a month, you guys can get 4 of these sheets every day. Very soon, I was unable to get back to an answer to my IT guy. We'll have it tonight. So I think we've got to find the last little glitch figured out on how to get these distributed so you folks can get this sheet on any item you want. But here's where I was just talking about, the PPM1, 0.2472, right at, you can see it's at a maintenance mode. It's got to be 0.25 or higher. Everything went in the maintenance. If you recall, just a couple of days ago, we were in still a T plus. If you look down here, is a T plus is uptrend, and if it gets above 0.50, it goes to a double plus T, which is an extreme movement to the upside. But everything is in maintenance. The 200 is in neutral range right now, and we look at the probability on the for today's range. We got 18 high projected, which is R1. S1 is 93, we're just about to S1. So the high probabilities right now, S1, R1. One of the things when I developed this sheet, this is one of the rules I put in there is how to identify the high low. And so now to get to 6332 is only a 45%. S2 is, there's more downside risk right now, potentially down to 79. So the range is, if it expands, potentially will be R1 on the upside. We could see a decent bounce there. Hang on a second. For some reason, my trading logged out on me. So these are the ranges that are likely. R1, S1 expansion right now is suggesting S2 to the downside, so 79. And if you recall, a couple of days ago, I did discuss the possibility of getting down into a 62, 60, 50 handle, and we did that, and then we bounced right back again. So there's still, so here's the summary here on this sheet. It's that we're still, I'm just looking here. If ppm 1 doesn't break back above 0.25, then we could start to see it's actually being forecasted to do this. This new sheet that I'm working on goes really in depth, also using the auto regression math to start to look a bit in the future. This is a snapshot of current, what the characteristics are out of that. That's what's going on there. So just seeing if there's anything else here. Oh, let's see what the trade opportunity is. Sell resistance. So it's selling. This is the first sell I've seen come out of the sheet. So 63.18. What I've been doing for these trades, I've been doing most of these trades. I've been maybe I'll go 2 handles under, so I'll go 16 or better to sell, and then on target 93, I'll go 95, 96. Or I might use a 5-minute chart watching for bottoming action or something there. So use some other tools when you're looking at these suggestions here. And then the obvious, if it keeps up like right now, it's giving the main trade that's out there right now is 62.94 S1 test, and it's got buy support target 163, so R1 target, then it's got 32, which is only 45. So if it's looking to buy S1, sell R1, we're pretty close to that right now. Matter of fact, we might have been, we weren't quite at it. In fact, I am, let me just figure this out. Excuse me, I'm just gonna, I actually just put some orders in for that lower target, just in case it gets down there and I'm not paying attention. Okay, so let's so nothing earth-shaking other than we are seeing. When I took this snapshot was early, and one of the things you'll see when you folks finally get this sheet in your hands is it's very dependent on the snapshot you take and where the market positions are. A lot of metrics will not change at all, but some of the metrics might change. And you can, when you get this, you can run it on an hourly graph. So you don't have to, this is a daily that I've run it on. So you can run an intraday and do some, I'm thinking right now that like a 4-hour chart would be awesome because it gives you some trade setups that you could be very tradable. So anyway, what I will do when I get this release, I'm doing multiple videos. I've already got the scripts laid out for a bunch of them. And so we'll be doing training sessions and all that, because I suspect there's a few thousand people that are going to have this sheet. And I want to avert all of you trying to call me or email me asking questions. So I'm going to do my best to run that off. Otherwise, I'm going to blow up my inbox. Okay, so let's go ahead on and let's take a look here and move on to the NASDAQ. How am I doing on time? Man, I've been going on, haven't I? Okay. So same patterns, very similar. Even though we're printing new highs, we're seeing that contraction of the volatility. Yeah, so I'll do gold here in a minute. Thanks for the super chat there. Appreciate it. I just happened to see that was up there. Yeah, of course. We've been saying that. Somebody says this is nothing more than a casino. Of course it is. It's a casino with probabilities. I have a good friend. Some of you may know him, Steve Kalasian, and he and I were in Vegas a couple years ago together, and we were standing by the roulette wheel. And I go, "Hey, Steve, check this out. This is a trader's heaven. They got all the metrics on the wheel and probabilities. It was crazy." So yeah, this is a giant casino, of course. And that's why math and probabilities and those type of things work. And there's a great book if you want to read a book. I'll do a book suggestion here. Is Against the Gods. It's by a guy named Bernstein. That is a fascinating book of math. It's really the history of math. So anyway, that's a good book. If you haven't read that, that's a must read. All right, so let's so patterns all the same. Looks like we're going to get a bit of a rollover. Maybe not until we get some of this maybe more selling coming into the short-term database. That should coincide with this is a moderate decline that's being forecasted. So let's just jump over. I'm going to light up the screen just for a second on treasuries. I did not mean to click that. Hang on. On treasuries, as suspected, we're right back to 434. Yeah, looks like we still have a little bit upward bias, but I'm still sticking in my range. 425, 450 on the 10-year right now. We're locked down. Nothing's going to change. If this is right, then this is going to lead us into a lot of Fed talk down the road. So let's go ahead and take a look at gold. It was interesting. I'm going to see if I can bring something up for you folks. Hang on. Perfect. It's on the other screen. Bear with me a minute. I'll see if I can. I'll bring this up if I can. Yeah, let's bring this up over here. This is last night's gold sheet, and it was S2 target, which was. Let me just bring this up so you can see it. This is gold. Sorry about that. S2, 32.83. It was trading at 32.95. Extreme 69 was a 55%. Okay, so I just wanted to bring that up. This was from last night's sheet. What did we get down to? 32.90. Okay. Let me just look here again. Yeah, so we came a little bit short of this, but we came right into 32.90 was it. Upside 98, 30, 33.23 R1. So I'm just looking at yesterday's analysis. So we got 33.25. So basically hit the range perfectly. But as we look, it looks like gold's trying to put another bottom. We've been kind of drifting lower. It really has a lot to do with what's going on with the gold trend right now. If we go to a weekly, we're coming into this big trend here. Let me just normalize this a bit. So one of the things that I've been talking about on some of the gold analysis is that we're going to continue this upward slope angle of attack of the 10-period moving average. Right now that is at 0.23, so we're right at trend mode. So we should basically trade either side of the 10-period moving average weekly, just simple 10. And that is right now, if I can bring that up, 33.32. So right where we rebounded back to, we should stay. You can see the red dots on a weekly are there. Let me just bring up a daily. These are always interesting patterns, folks. I'm going to show you something, especially those of you who have the indicators. If you don't have them, kendallreport.com/indicators, and you can find out more about getting these. But when you get these upward and downward, you get Fibonacci targets up and down. You say, okay, what does that mean? And what we do is we go to the PPMs, and we've got a mixed, we've got no momentum to the upside. So these numbers, I'm just giving you rough numbers here, are those are 3609 on the upside. On the downside, we're looking at 3150, just round numbers. So we're really, what it's really telling us, and that weekly chart I just shown you, is we're in a slight uptrend, and you're just going to stay in a fairly tight band on a normal volatility band. So these, you can see here, let me just blow this up so you can see it a bit. We've got this very contracted range on the daily market grid. You can see the ranges right now. We're looking at right here is, let me just blow that up and I'll bring it up on the screen for you here. This is the daily range being projected for today. As we're looking at extreme 3370, on the downside 3274, and then I haven't run the sheet, so you get the Substack, kendallreport.substack.com, $8 a month. You get that, and this sheet will be out there tonight on a daily, so it will tell you which is the targeted levels here. We're up $4 at 32.21 to 30. We've got R1 at 33, so resistance 33, 33.46. And as I've told you, these data sheets that I built actually were trained and to think like me with all the metrics, and that's what's really exciting about this other project that I've started. Okay, let's do a quick review of Bitcoin. I'll go in depth in tonight. Yeah, if you look at last night's data sheet, you'll see we did get the STX last night. We're continuing to bump up against some of these metrics here. We're seeing a little bounce again, so we're still following these moving average projections here. So if you're new to the channel, these dots here are forecasted where the moving average is going to be. The red dot is forecasting basically the close as we go through the next several days. So it looks like it wants to maybe react off of this extreme value that we hit yesterday and come back in toward those levels. So still definitely big time in the uptrend. We're at 0.34. We're in confirmed uptrends on Bitcoin. We continue just to hover right along and go along that angle of attack there. All right, so let's do this. Let me see what yeah, thanks, David. I appreciate that. Let's see what you guys got going on here. Yeah, blackjack is the best. You're right. So I will tell you a little casino story. I used to live in Lake Tahoe many years ago, and I went down and I wanted to prove even right or wrong a random theory, uh, and I used the quarter slots, and I developed I point and you know how you can keep the credits and numbers. So I point and figured 1 by 3 point figure chart on a machine and determined how to trade the numbers out of a quarter slot. I don't even know if they have them anymore. I've been in a casino for decades, but no, not playing machines is what I meant. But the point is, I was able to point and figure these, and I would watch little old ladies pouring quarters for hours and being frustrated, and I would switch over to there and then start another new chart up with that, and actually was able to after about 2 months of trials, well, not every day, but probably about 15, 20 sessions, I was able to come in where I could actually make money on a quarter slot. Which have one of the lowest probabilities. The joke, they used to have nickel slots back in the old days. This was back in the 90s, right? And early 90s. And so nickel slots paid the light bill, quarter slots paid the rent, and dollar slots broke even. So I actually had a buddy of mine that lived, if you ever read the Market Wizard book, Ed Sakota, Ed had a slot machine, a dollar slot in his house. Yeah, that was certified. It was actually legit, so it was kind of fun. All right, so let me look at some other comments you guys have. Yeah, somebody, Stay Green, let's see here, 2.7 incoming. If you look at my beautiful big bill, I was able to come up with about that amount. Trump's always running his mouth about 14 trillion and all that stuff. Haven't been. Yeah, that's interesting that somebody says they're not getting notifications. They've been throttling my channel for years. I've been stuck. I was at 32 or 35,000 for a year and a half. And meanwhile, getting, 15, 20,000, I don't get the views. I haven't been consistent because I've had the channel shut down because of personal reasons. Yeah, so Roger said market's at all-time highs, so save your calculations for another era. So, if it goes to that, guess what? Our models will work. That's okay. I'm not predicting anything. We are primarily trend followers, and I've been running those same models for decades, so they're well tested. Yeah, so Robinhood, when you enter a trade, does it often go down? 95% of every trade you put on, I put on a couple of positions, I'm negative right now. Everything will go against you before you. Otherwise, somehow you would be able to think that you could pick a perfect entry, you bought it and it goes up. Those happen for most time. That's not it. Let's just see what y'all been talking about here. I love being able to interact with you guys. Yeah, just looking here. Yeah, I don't. That notification thing really bugs me. Now, yeah, Martin Armstrong. Don't know him. I'm just looking at a couple more comments to see if there's anything out here. Let me read just for a second, folks. Yeah, as we get closer to Fed, interest rates on a 10-year is just stuck. Uh, just see a comment here. Can you talk about the Fed? We'll do more of that as we get a little closer to the next meeting, but rates are stuck maximum on the 10-year, 395, 450, most likely 425, 450, maybe a couple little dips. We printed down to 421 one day, came roaring right back to 41. So not much is going to change in rates, I don't think. I don't think the Fed does anything this time, no matter how much static is around there. I don't see anything happening there. I think it's just going to stay the same here. Hang on, I'm just trying to get my, there we go. I couldn't get to the bottom. Yeah, so casinos are paper vouchers, just like your brokerage account. Same thing. Yeah, somebody's saying 8 trillion. Yeah, Trump is always running off about stuff. Yeah, I'm sure a lot of X and YouTube getting bearish, shorting. Yeah, I'm sure. Um, yeah, the volume's low. Listen, I always I look at volume a lot different. So if you have an uptrend with low volume, that uptrend can go forever. You don't want high volume. But volume has nothing to do with prices and movements. It can in very small moments. And where are we at here? Yeah, we're just right at an hour. I like to quit at an hour. But yeah, so a lot of times you see big volume. They're even climactic days or they're churn days, and the low volume that the market goes up, steady, like we get 0.3, 0.5, 0.6 on low volume. Those kind of rallies or going down can last virtually for a very long time. When you finally see the big volume day, and let's say the market surges, I call them like a flush, and you get the big surge on high volume, that's probably close to the top or the bottom, depending where it's at. Those are more climactic, where everybody even got caught in the shorts or pulled the trigger at the same time. Volume, I guess I have to do it because I can't leave you hanging here. So I spent a lot of years in trading floors, and if I'll do a quick example, what moves markets is aggressive volume, not and I'll give you a quick example. If I have a million shares to buy, and we'll do trading bit old school days, and I got a million, and the other guy's got a million to sell, and I'll do make it easy for I've been doing this for many years, but it's half bid at 5/8, and so I go, hey, bid for a million. The other guy goes, offered at 5/8 a million, and we just yell and scream at each other, and no one trades. He doesn't come up, I don't come down. And so I can see the volume, and he knows what's there. I know what's in front of me, so I might not be very aggressive. But let's take another scenario where I have a million, but I'm only showing 100,000, and the other guy's he's showing 100,000, and maybe that's all of his trades. So what I'll do I have a million to buy, I will go and buy his 5/8, and immediately I bid. You see this happen in digital order books all the time. as I go from 5/8 or half to 5/8. I buy his 100,000 and I immediately bid maybe 300,000 for 5/8. And he goes, whoa, he backs off to 3/4. Now he's offering at 3/4, and maybe he shows me 100. I'll buy his 100, and I'll raise. Basically, it's like a poker game, right? And I raise you to 3/4. He goes to $1, and I just keep bidding them. That's why when you see, if you watch an order book or a market start to move very fast, that is what's happening. You've got maybe a group of buyers that they don't. I always say they don't care what the price is. They just want to own this thing, and they've got size to own. So they're going to just grab anything that's in front of them. That's why you'll see those flushes. That's why you'll see movements in the stock. Now, if everybody's showing their volume and you go to order book like on a level 2 and you see lots of volume on both sides, that's kind of the range you'll stay mostly in there. But the nice thing about having big bids or offers out there, if you have a group of traders, they'll go and take out the offers and then just offer them down, and they can move the markets very quickly. So probably the best thing, I've talked to folks about this for years, probably be good to be able to getting very close to those 94 buys right now on the S&P. But the concept to actually understand what moves prices is the aggressiveness of the buyer or the seller, not how much, because a lot of times you don't show you're selling, you just start taking out offers. And if you throw the offer in all at once and you get a terrible fill, you can work your orders better. So having been a floor trader for many years, those same techniques happen from the algorithms are programmed to do these things. And it's very interesting. That's why you see these big runs when the algos come and they've got virtually unlimited book of business to buy, and they can do that technique to bid them up. I can tell you about 4 years ago on a penny stock, I demonstrated this to a buddy of mine, and we bid this penny stock from $1.22 to $2.10. I had multiple accounts, and I showed him I worked the 2 orders, and we were basically trading against an algorithm. So the algorithm just kept putting out a little bit of stock. So I was able to raise the price by doing this technique that I just talked to you about, and all of a sudden it's trading at 210. Of course, it's probably not going to stay there unless, but what happens oftentimes is you bid it up, all of a sudden somebody else says, oh, look at this price, and you start to bring volume behind the trade. So this is something that everybody that's been on level 2 trading floors, all the algorithms know this kind of technique, and this is how to get markets to move. And if you're at key points, you can bid things through. People say, well, they're cleaning out stops. Maybe sometimes. I don't use stops, so I don't know. But I can tell you that even on my floor trading days, we didn't really know where stops were. We guessed at them. Maybe there's stops above $1, above this or whatever. Sometimes there were, sometimes there weren't. We could run the markets, but the algos are really good in the digital world because they can actually do this. And if you have multiple, high frequency type traders around, they can move the markets around pretty good. And that's a lot of times you'll see those flushes. When I see a flush up or down, I usually take the other side and scalp the order if I can get filled. So anyway, we could go on for hours on that, but thanks for asking the question. Last thing I'll look at. Yeah, so Tim asks, so big gaps up and down. Big gaps up and down are using news driven, and all gaps are not filled, by the way. Okay, that whole fill the gap theory is okay. It's okay, but sometimes they gap and they go, and it doesn't work out that way. So be careful thinking that you can short something that gapped higher and somehow you're going to get paid. It can be pretty brutal from that standpoint. So we printed 94.25 on the S&P. So we got right into that buy range. I got filled on, still got a couple more just below there. I think 92 was the buy range, so I did 94 So I've got a few more down all the way into 92 there. So we'll see if that trade. So the trade is on S&P 94, looking for 312 on the upside, I believe. Let me just, yeah, that's what it was. So anyway, okay, folks, this is it. Thanks for hanging out. Sorry for yesterday. Hopefully you got a lot out of this. If you don't, get the kendallreport.substack.com, $8. On this weekend, I'm going to turn off the $80 annual feature. That's going to go away. Maybe we'll do something for holidays. So get that. I think it's $6.50. Get it for a year. And then also the indicators. You're going to definitely want to load up. You're going to need the indicators to run these fact sheets and some other things I'm doing. Anyway, thanks for watching. Have a great evening. We'll see you guys soon.